Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. Our show today is brought to you by my company, Bull Realty. If you'd like to buy or sell office buildings in the Southeast U.S., reach out to me personally. My email is a real easy one. It's michael@bullrealty.com. So if you finance them, if you just want to put in equity, if you want to buy notes, if you want to sell notes, if you're a lender or a borrower have an issue, I deal with that and have tons of experience in it. And my specialty is office in the Southeast U.S. All right, let's get to the show because we're going to talk about office today. You know, and I think maybe it's because I sell office buildings that I really love talking about office, but I think it's also one of the most interesting sectors right now because obviously this audience, you guys are very experienced in commercial real estate, and you realize the office sector is one that's kind of taken the most hits with well, of course, the higher interest rates back to more historic normal rates, but you know, every sector seems to be performing fairly well out there for the most part, except some office properties. Now, medical office doing well, government seems to be doing really well still. We'll see what happens with what Trump's doing, and then a lot of the really nice buildings in some of the areas, the small buildings doing really well, but then obviously there's some buildings still in distress. Well, let's see what's really going on. Please welcome my guest. It's Phil Mobley. Phil is the National Director of Office Analytics with CoStar. Phil, good to see you, and I love the beard, sir.
Thanks. Always a pleasure, Michael. I love talking about office too, so let's do it.
Yeah, you must be the most popular man at CoStar in research and analytics these days because I think most people have more questions about office than really any other sector, right?
Well, it's been, as I say, it's been a great time to be a market analyst because it's just been absolutely fascinating.
Yeah, it's pretty crazy, and you know we're on maybe the first line being brokers, but we're seeing a lot more activity both on kind of the core stable side and also on the distress side. So let's talk about the capital markets first on building selling. Kind of what are you seeing out there nationally on cap rates, and what are you seeing on kind of velocity of transactions?
Sure. Well, at the end of 24, we definitely saw more liquidity. So sales volume was up something like 40% quarter over quarter. We had the nice normal pattern you'd expect where volume rises as you move throughout the year. So we finished in a range that looked sort of normal. So with more liquidity comes kind of the last phase of price correction, at least typically in a recessionary period. So we do see cap rates maybe getting close to their peak. You know, there's no such thing as the average office deal, right, as you sort of alluded to in your intro. But if you were to average everything out, then I think we're looking at maybe mid-eights on cap rates. And that's up from a trough somewhere around 7 in 21. And we always felt like the peak to trough, or I guess the trough to peak, would be something like 200 basis points. So I think we're almost there. There's a little bit more price discovery or realization to come. You know, that CMBS delinquency rate keeps ticking up. It's around 10% now, way up from what it was a couple years ago. So I think there's some rocky roads ahead, but more, I guess, understanding of where values are and will settle out.
What about your predictions moving forward and throughout 2025? What do you expect to see for either cap rates? I don't know if anybody knows that, right? But you guys know more than anyone, and velocity on transaction volume.
I do expect we'll see more volume. Rates, while the 10-year has not moved down along with the Fed cutting the federal funds rate until they paused a couple weeks ago, at least they haven't moved up a lot. It's still been pretty volatile. But I think more than that is a lowering of the bid ask spread for at least certain types of office, right? I think people know what a trophy office is now. I think people know what a single tenant net lease office is now. You know what a medical office building is now. So, for a lot of types of office buildings, there's greater understanding of what the true value is. And I think with that understanding, we'll see more liquidity. And of course, part of that is also just a broader rising tide of more real estate deal flow that is related to general financing conditions, which are slowly improving, I guess.
Yeah, yeah, that's a good point. And it seems like the clients that we're talking to in the office world are a little more understanding that, hey, maybe we're back to more historic normal rates. And for all of us that have been in business a long time, remember when a 10% cap rate was sort of normal, right? Average cap rate of 10, and it's amazing. We're seeing cap rates on deals we're selling at 12%, 10%, 7%, even one at 6%. So it's really a very specific market, isn't it, for the actual asset, its location, and of course the tenant and the lease.
I think if you could sum up this market in one concept, it is a tactical market, right?
Mhm.
So the deal, whether you're buying a building, whether you're selling a building, whether you're trying to lease up a building, whether you're looking at a building and thinking what is the highest and best use of this particular property, you better understand the fundamentals of that particular micro segment of the market, right? It's not a situation where just the general current of interest rates or economic growth or what have you is going to save your asset. You've got to really understand tactically what are the fundamentals at play here. I think you've hit the nail on the head.
Well, I like how you added the word "set" to that sentence when you talked about asset, save your assets. So good work there. uh, what about last time I talked to you? You had seen an increase in the percentage of sales for office properties that were to owner occupants or partial owner occupants. What's the latest there?
Still a trend, maybe peaking out a little bit. So, space users over the last year plus have been involved on the buy side of about 25% of office transactions. So, that's double their historical average. Now, in the last quarter, we started to see a little bit of an increase in institutions and REITs coming back into the market, still well below their historical average. But we could be nearing an inflection point, although that trend of owner users is still definitely something that's active in the market.
Yeah, it's interesting on the deals we have. Just for some examples, we've got owner occupants looking at buildings that are 50% occupied that they're getting for 25 to 20% of replacement costs, and they're feeling the problem. And then we're about to bring out a $53 million institutional portfolio that at a really attractive buyer cap rate. So it's we're still getting some pricing discovery, aren't we?
We are, and I think one of the things that's sort of coming not really out of left field. It's just that we've been talking about the demand side of the equation for so long. But the new force that's emerging is the supply side, right? So the construction starts have been so low. Last year, there were only about 14.5 million square feet started. And that was a good quarter in 2017 or 18. So the supply pressures are easing. They're going to be very different in the years ahead. And that matters if you are an occupier looking for space, right? It makes sense that you would look at maybe a half-occupied building and take advantage of some high-quality space at a discount, knowing that there's not going to be that much coming down the pike. There won't be that many options for that kind of high-quality headquarters space.
Yeah, good point. And also, yeah, the pricing won't be there. It'll be higher, but also just the selection, right? It's one of the challenges we've had with owner-occupant acquisition searches is finding the right bill in the right location, because most landlords are like, no, we're not selling. We'll lease, but we won't sell. So it's a nice to have some options for these buyers. Well, Phil, let's talk about performance. It seems like we're hearing and seeing our office tenant rep here in Atlanta is seeing more of these tenants who took too little of the space or downsized and are needing more. We're seeing more activity. We're seeing more companies coming back to the office and demanding their folks to be back. What are you seeing on the performance side when you look at the nation overall?
So we did see in 24, especially toward the end of the year, what I will call a momentum shift in the market. I am a little hesitant to use the R word, recovery, um, for one reason mainly, which is that what we've seen is the momentum has shifted very narrowly. So geographically speaking, in particular, New York City, which is it's numerically important, right? It's 10% or so of the office space in the country. It's kind of mind-boggling, but
Mhm.
also just culturally and economically, and from the standpoint of setting trends, it's very important to the country. And uh, that market truly is beginning to recovery. They've had three consecutive quarters of positive absorption, and in the fourth quarter of the year, there was almost 3 million square feet of occupancy added in just New York, which is pretty normal by sort of pre-pandemic standards for that market. Now, nationally, there was also a little more than 3 million square feet added in the last quarter. So, what that means is that you have New York sort of being the net positive, and then everything else is, relatively flat. Of course, it's not actually flat nationally. There are some winners and there are some losers. So, in places like Austin or Nashville, we see leasing volume picking up year over year, accelerating from a place where it's already above what it was before the pandemic. So there's a handful of markets like that. And then you've got a handful of markets like Houston or Miami that, the leasing activity may be pulled back a little bit year over year, but it's still above what it was before the pandemic. So those markets have already been in that recovery zone. You have places like San Francisco, which still pretty far below its historical norm, but leasing volume picked up 40% year over year in 24 in San Francisco, and even accelerated a little more toward the end of the year. So I think there's maybe some green shoots there. On the other hand, Boston, Los Angeles, DC, leasing volume actually slowed down in 24 relative to 23 from a place where it was already kind of below its pre-2020 norm. So there's a lot of variability geographically. There's a lot of variability across types of office buildings. And that's really why I'm hesitant to say, yeah, the market is beginning to recover. Now, if we see this last another couple of quarters, if it broadens out past, a handful of markets, then yeah, I think there are signs that it very well could do that, and then we'll be in the midst of this long-awaited recovery.
What are you seeing for rental rates, Bill? It seems like the the face rates haven't changed that much in the markets that we do a lot of work in. Obviously, effective rents have come down a little bit. What do you see overall?
Yeah, that's been the general trend
Mhm.
is holding those face rates as stable and as high as possible while offering concessions on the back end to try to get occupancy. I do think we have, in most places, reached peak concession.
Mhm.
Um, Part of that is related to the supply side, as you mentioned a few minutes ago. There's just not a lot of availability left for that kind of premium headquarters type space for occupiers. And so, in part because of that, landlords have not had to continue raising the amount of tenant improvement allowance or free rent that they're offering. On the other hand, some landlords also reached that ceiling because they couldn't afford to finance additional TI allowance or free rent. So I think we've reached kind of peak concession, whereas in that premium segment of the market, even the asking rates are starting to maybe tick back up a little bit. So um, stable, slowly growing rents. In fact, we recently revised our forecast. We had been anticipating rents to actually be negative, to grow negatively in 2025. We have revised that recently because of this change in momentum. And we're looking for sort of a paltry, 1% or so year over year growth rate for the next 12 to 18 months.
Yeah. Well, I'll grab onto that. I mean, any increase is potentially good news for the office market, and we certainly need it. Do you expect the lenders to work through more of the distress office loans and impact the market this year?
I think we will continue to see a lot of what we have been seeing, which is that as long as there are extension options and opportunities available, and as long as, you know, both lender and sponsor sort of agree on the value of the asset, at least the conceptual value of the asset, then I think we're going to see workouts and extensions for as long as possible. When those can't happen, then yeah, I think we'll see more distress, more short selling. That's part of that long reset in values. I have heard from lenders that in sort of another universe, they would be looking at current market conditions and thinking, yeah, we could make some office loans here. There are some opportunities out there. But in this universe, the one that we physically occupy, we have too big of an existing portfolio to try to work through. It's taking too much of our headspace. It's hard to convince different partners. It's hard to find the right sponsor. So it's difficult for your sort of traditional institutional lenders to be active in making new loans. But I think they will continue to try to work in good faith for those buildings that they sort of believe in the prospects of the building.
Yeah. Well, good point. And we're seeing that a good bit. We're pretty heavily involved with lenders and borrowers on distressed office deals. And it seems like more of them are working together. And if the solution is to go ahead and sell it because the values have changed, right? They're not what they were in the office world, and kind of doing an orderly marketing process for the borrower, with the lender, accepting the hit. So we're certainly seeing more of that. Phil, what's your thoughts on the impact on the economy and on the office market with the Trump effect? As you know, as you see it today, I know it's kind of still unfolding though, with DOGE, with tariffs, and the things that are going on there. Do you expect some impact to the office market?
It is still early days, and a lot is happening, and a lot is happening really quickly. So
Mm-hmm.
I think, as we're sitting here in early February, um, there are real actions that have been taken already. The Department of Governmental Efficiency, just in the last 24 hours from when we're recording,
Mm-hmm.
announced that they had brought the number of lease cancellations up to 22. It's a drop in the bucket compared to all federal leases, but it is a start. There was a story just this morning that I saw that indicated 20,000 or so government employees had already taken advantage of the option offered to them to resign, and with a sort of an 8-month runway of compensation. Um, More are expected before the deadline. So there's definitely pressures from the government already that would tend toward reducing their occupancy. It appears that those pressures are probably enough to swamp the counter pressure, which would be from the requirement for federal employees to attend more frequently. But both of those are happening right now in sort of contradictory directions. And what I sort of expect is that in certain micro areas, that pressure resulting from attendance requirements, which of course it includes government workers, but it will also affect the contractors who work with those federal employees and do business with them. So I expect in localized areas that will increase vibrancy, that will increase the traffic in those office buildings, will help the retailers around them. On the other hand, what will probably be, I think, a bigger effect is the disposition of federally occupied space, including some space that they own, um, which will, in the long run, reduce total occupancy in the market. So it's not going to be an even effect. I don't know that I take at face value some of these really, in my opinion, almost outlandish predictions of, oh, the government's going to get rid of half its space. But I do think there's something meaningful that's underway, although it's still early days, as I said.
Yeah, good point. We just did a show on government usage of these buildings, and it seemed like the biggest challenge with improper use and improper maintenance and capex is the owned buildings. I have a team here. We focus on selling GSA and government leased office properties, and the ones that are leased, everyone that we've dealt with leased are really in good shape, good condition, being used. So from our angle, it looks like it's more of the challenges with the buildings that they own, that they really haven't had the budget to take care of these buildings. So will be interesting to see what happens if they start to sell some of those properties in markets like DC, right?
It could be very interesting, and in fact, it could have a similar effect if you could sort of imagine that the government were subsidizing the purchases of buildings for repurposing or redevelopment, right? So if the government sells buildings that they own, and they're doing it at a price to clear the market quickly, then that would be kind of similar to if they were offering subsidies for redevelopment or conversion or what have you. So it is on one level sort of exciting to see what could happen to some of those sites at some of those buildings that are maybe full of deferred maintenance, and aside from that, perhaps not worth what they would have been 10 years ago.
Yeah, that's true. Phil, what do you leave our audience with to think about for the office market moving ahead in 2025?
I think that we're looking at an office market that is fragmented geographically. It is about, as I said earlier, tactically understanding the fundamentals at play in the market. New York has this strength in the financial sector. Other markets like an Austin or a Nashville or a Raleigh, there's a lot of growth in A, just population, but B, in the types of professional services that serve that population. So whether that's accountants or lawyers or healthcare is another one. So markets with a lot of healthcare demand driven by an aging population, those are going to be opportunities. In your Chicagos and your San Franciscos that have, exposure to sectors that are not growing as fast, it hasn't been employment growth in technology for a couple years now. It's a different challenge. So I think that there it's about really getting into the micro level of demand drivers. So it's a fragmented market. Those that have tactical expertise and play their cards right, I think, are the ones that are poised to succeed.
Yeah, well, good point. I think, in my opinion, we're going to look back at this decade, and the office investors are going to be the ones we look back and go, wow. It seems to me, from being in this business for a long time, that a lot of investors have made money buying in down markets when people said markets were dead. To some of the points you made today, I think some of these buildings do get torn down and some get converted. And then we have more tenants wanting their folks back in the office for cybersecurity reasons or trade secrets or just culture, and then you have the kind of the normal growth, and then you add the lack of new supply, and I'm still in the camp that it turns around faster than kind of we see right now, and I'm glad that you're seeing some green shoots and seeing some positive signs.
For those that are ready to take the risk, then I think the opportunities are certainly starting to become visible.
Yeah, that's true. Well, Phil, thanks for joining us, sir. Great information as usual. Thank you.
All right, you're very welcome. Look forward to next next time.
All right. All right. And thank you for listening or watching all around the country. Please let us know what you think. Reach out to me if you have any thoughts or questions, or you need somebody to do anything anywhere in the U.S. My email is an easy one. It's michael@bullrealty.com. Until next week, be sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty, commercial real estate sales, leasing, and advisory services. Visit bullrealty.com or reach out to me directly. My email is michael@bullrealty.com. By ShareFile, designed with real estate and other highly regulated industries in mind, ShareFile offers secure digital solution to simplify workflow and improve collaboration. Visit sharefile.com. By Commercial Agent Success Strategies, 21 cloud-accessed agent training videos. Learn more at commercialagentsuccess.com. You're invited to subscribe to the show wherever you listen or watch the show. You're also invited to subscribe to a weekly email announcing the show topic and guests at creshow.com. Thank you for watching, listening, and sharing America's Commercial Real Estate Show.